Hi, this is Nadine Terman. It's January 5th. Today we're going to talk about earnings downgrades. Not a fun topic, but one that we're going to be dealing with pretty soon. The way downturns work is that multiples first come down, hitting risk assets, which we saw in 2022, and then earnings/cash flow come down that also hit risk assets, followed by credit issues. So obviously we saw that multiple contraction in 2022. Our team's written a lot about in the past couple of quarters how that baton's going to be handed off from the multiples to earnings and cash flow in short order, which then obviously affects balance sheets and credit. Analysts have been taking down their estimates and price targets. Companies have been talking about shedding labor, as you've seen with Amazon, Salesforce, many others. But you're going to have the analysts begin taking down their estimates and price targets a whole lot more. And we think we're going to see more of this trend in the upcoming earnings seasons that's going to get started here in January and February. So even though next 12-month consensus estimates have come down, so about 5% down since July for the S&P, it's down from the fall peaks for the stock 600 and MSCI Japan, and heaviest Asia ex Japan, down 17% from the first quarter to October. There's still wood to chop. And so let's take a look at the first chart. You can take a look at these global PE ratios. We're showing the S&P 500, MSCI World. This is the 12-month forward PE ratios. MSCI Japan, stock 600, FTSE 100. You've seen it come down, a little bit up, a little bit wavered down, but obviously a lot further down than January of 2022. But you can imagine going into a recession, that's probably not going to be enough. So the gap between consensus estimates and actual results tends to happen when big macro things are going on, like now. Historically, per Absolute Strategy Research, which thank you for the chart here, consensus was 30% too high during recessions of the 90s, 50% too high before the GFC, over 40% during the GFC. So earnings could be down a whole lot more from here. Even if it was like 10%, you'd be a whole lot less than what we've seen in the past. It would be a mild revision versus those. And because of the jump in rates, Russia's invasion, supply issues, we know all the points, we saw a number of cyclicals outperform. So I'm going to go to a second chart here, thanks to ASR, that I actually thought was extremely useful. So we know the data, but it helps to have it in a picture form. So if you're looking here to the right, you're looking at the level of cyclicality. These things are more cyclical. And then here up to the left is performance in 2022. So things like basic resources, banks, industrials, obviously energy, performed very, very well relative to other sectors and industries, but they also tend to be more cyclical. And then for the less cyclical folks who usually outperform, like software, tech, hardware, retail, didn't perform very well. They were relative underperformers, even though they're less cyclical. So we saw some of those cyclicals outperform, and a number of less cyclicals underperform in 2022. So if you're looking for that hunting ground for shorts and longs respectively, you can focus on these outliers. And while rates are going to rise here in 1.5 22, so the long duration stuff, that's why it got hit. That's why it makes sense, right? Investors could get a little bit more comfortable with those long duration assets because the story isn't new after that point. With the US more heavily tech focused, with Europe having an earnings beta of 1.5 times to the US, we could see US tech become much more loved eventually, and some of those European industrials, cyclicals, financials being a whole lot less loved. So this is here for the US, but you see similar things going on abroad. Also, margin downturns are not pleasant for a number of sectors that pulled a rabbit out of a hat in 2022. You can see that again on the right-hand side of the page. Who are we thinking about? We're thinking about those industrials. We're thinking about travel and leisure. We're thinking about some of the materials companies. And during the last 4 recessions, the median peak to trough downturn, that drawdown, was 34% for cyclicals versus the current drawdown of around 8%. So putting that in perspective, if you're looking on potential longs, potential shorts to be gearing up for, getting your homework done here into 2023, we're giving a little snapshot today. That's all, and I'll talk to you tomorrow.